Hello, I'm David Buckland and welcome to this week's Video Insight. The leak over the weekend from the Australian Government Treasury in their advice to the incoming ALP government had the following important messages. Firstly, the Treasury advised that the federal budget cannot be fixed on a sustainable basis without raising taxes and cutting spending. The Treasury favours lower taxes on individual and company income to increase workforce participation and give workers a fair go, and modernising business tax to boost investment. Treasurer Chalmers plans a roundtable discussion in August with tax on the agenda, but it seems an increase in the GST rate from the current 10% would proportionally hurt low-income earners and not be entertained. Instead, his focus is on doubling the earnings tax on superannuation balances exceeding $3 million, while blocking any discussion related to both unrealised gains on asset values and indexation of the threshold. The United Kingdom, for example, has a GST equivalent rate of 20%, an effective death duty on wealth exceeding £375,000. So in that context, Australia is not necessarily in bad shape. Second, the government target building of 1.2 million homes and apartments by 2029 is dead in the water, and a significant shortfall seems likely. With a massive jump in the price of timber, steel, labour and regulation, the housing crisis is likely to continue for the balance of this decade, as demand, mostly from net immigration and natural population growth, continues to exceed supply. Unfortunately, both sides of politics are obsessed with the big Australia, and it is difficult for housing, infrastructure, health and education to catch up, placing pressure on most Australians' quality of life. Third, the Treasury did some scenario analysis which included a loss of confidence in the US dollar as the global reserve currency and the loss of independence of the US Federal Reserve. With President Trump continuing to jawbone the US Federal Reserve Chairman Jerome Powell into aggressively cutting the US cash rate, this concern is increasing, particularly given the likelihood Powell will be replaced by a Trump acolyte by May next year, or before if Trump has his way. Fourth, the risk associated with financial disruption has increased from tariffs, potential trade wars, increasing US and European government indebtedness, the ending of most countries' defence holiday, and President Trump's unpredictability. Increased volatility is seeing both gold and Bitcoin continuing to challenge their record highs, and this appears likely to continue. That's all I have time for this week. Please continue to follow us on Facebook and X.